Hey everybody, welcome back. Today I wanted to go over something with you that's some information. I learned about it actually on the internet from a financial planner, and I actually want to show you the software that actually implements this solution. So stay tuned. Great, so if you haven't tuned out, the model that I want to tell you about is called the Guyton Klinger model, and it's essentially a refined version of the 4% rule. And if you know how the 4% rule works, essentially it is if you take 4% of all of your, like for example, total account balances, presumably post-tax, I would imagine, you shouldn't deplete your retirement income by the time you pass away. That's the notion, because if you're only taking 4% of balance, presumably you're going to get that return back in the stock market if you leave the principal alone. That's the whole concept of it. So that obviously has fared well over time, and I know that in this current inflationary climate, that 4%, I think it was a 3% rule at some point, but I think now it's 4%, and now I'm sure that's going to go up to 5%. Just because of the nature of inflation currently. But there's a different kind of methodology that I think is a little bit better and takes into the account of market volatility and variability in the economy. And as you know, the problem, or maybe you don't know, but one of the things I've always struggled with many of these different models and forecasting solutions is the inputs typically tend to be static. Like you don't have this variation of information. And that's a bit misleading because that's not how the world works, as you know. And so this concept of Monte Carlo simulation came up, and it's probably the best way of factoring in all the average of a whole slew of different paths that possibly could happen in your retirement journey, and then gives you the best case, worst case, where are you in the confidence interval, etc. And it's a really good indicator of where you are, because assuming, the returns are 0 to 100, then anything, the population of data that you are going to be in some component of that retirement universe is probably in that curve somewhere. You just have to figure out which is the path that it went. So there's a couple of software solutions that I actually look at very closely. One is Bolden software, which I find to be really the best for all of this. And I like it just because it's very comprehensive and it's got a lot of different pivots on the information so that you can make a very good decision about your retirement journey. So check it out, Bolden software. Many people out there on the internet and retirement guys are talking about it, so I won't go into too much detail here. But the one solution I did want to show you was this one that does the Guyton Klinger implementation, and it's called Income Labs. And Income Labs is really embracing that whole concept of guardrails in your retirement journey, and implementing that to give you an accurate forecast of what you can spend. Because if you break the retirement scenario down to its simplest form, you will never run out of money if you don't spend like a wild person. That's really just it. I mean, it just is it's a matter of discipline and a matter of change in behavior. Like you cannot be even though you have maybe multi-millions of dollars, you can't be spending all the time for extravagant vacations. You got to live within your means. I mean, this is just basic living strategies. Live within your means or live below your means and live comfortably. And at the end of your period, when you can no longer work, presumably that discipline has accumulated a nest egg worth several millions. And it's true. I've seen many people who have implemented that. They never drove the most recent automobiles or had the biggest house in the block, but they are doing better than most people because keep in mind, when you have all of those things, everything's relative. You spend more. So that's the operative word, is spending. Manage the expenses along the way. And that's what a Guyton Klinger model does for you. It manages this concept of variability in the marketplace so that you don't overextend yourself by hitting the money that's going to make you continuous compounding, money upon money. And now with software solutions that can do this computations very quickly, these things have come out. So let me show you Income Labs so that you can get a flavor of how this company has implemented this strategy. And again, it is just one data point in the retirement journey. You have to, in my view, everything has to be a 360 view. You have to take all data points, even some of which may not reconcile with, say, for example, Bolden's. I've had that situation already with another software solution And I mean, Bolden's telling me 99%. This other thing is telling me 80%. I mean, that made me uncomfortable. So again, garbage in, garbage out. The other thing is that some of these things are black boxes, so you don't really know how they implemented things. So that's just something else to keep in mind. All right, so let's go to the Guyton Klinger model, and I wanted to show you the solution from Income Labs. So let's get that fired up here as a moment. Great. So before we get there, let me just explain. I found this on the website. Investment with insight. So why is the Guyton Klinger method superior? It offers several advantages over traditional static withdrawal strategies. And that's the key, right? It's like you can use 4%, but there'll be years if you are doing not too well, that 4% is going to really eat into your principal. So here it is, unlike the 4% rule, which suggests withdrawing a fixed percentage of the initial portfolio each year adjusted for inflation. The Guyton Klinger method adjusts withdrawals based on the performance of the portfolio, right? And the dynamic approach helps protect against the risk of depleting the portfolio during prolonged market downturns. That's really just the basis of it. In another way of kind of characterizing it, rising tides cause all boats to float, and that's what this is, right? Even lowering tides cause all boats to drop, and who knows, you know what happens there. So that is the basis of the Guyton Klinger. I would highly urge you to go out on the web. I mean, there's a ton of information out there. Even ask ChatGPT. I did a video about that yesterday, and it can give you some more information around that as well. Okay, so here we are at www.incomelaboratory.com. So let's take a look at that. Income Lab. I think this is Income Lab. Here we go. IncomeLab.io. And IncomeLab.io. Right now, there's a great deal here for $20. I would strongly urge you to pick it up. You know, try it out. I did notice that this is probably better optimized for financial planners, but that doesn't stop you from doing it yourself, right? So it's just one more data point. I will say that I do like the interface. It's really very good, and you know, a lot of graphics, etc. That doesn't make a good software solution. It's what's inside the engine that makes it good, but I will have to say it's very intuitive. I liked it. And it was kind of easy to set up. I created a household here called the Soon Retiring Household. Retiring soon in 70 and soon retiring in 79. That's really the basis of, you know, what you input into the system. So, for example, if you were to take this portfolio, which all I did was made a sample portfolio. I just said, put in 450,000 from soon retiring soon, and put another 250,000 in soon retirings, 401ks, right? One at Vanguard, one at Fidelity. This came up with, and then it is coming to you with a set of predefined asset allocations. These are standard asset allocations of 50-10, 15-25. Personally, I don't go with this way, but you know, and that's what caused my portfolio to do very well. But equities right now in the past decade have way outperformed any other asset class, but you know, that's not to say it will. Now, there is a couple of nice bona fide things coming out as of the time of this video. And one is that Donald Trump is trying to lower interest rates in the economy. If he does that, and if Jerome Powell and the Fed do lower the interest rate, that's going to massively stimulate the economy, right? Because the opportunity cost, if you can get a bond that's paying 5% and it's risk-free, that's a really good deal. I mean, I just actually purchased some bonds the other day, and although one of them was a mortgage one, it got called. But regardless, at 5%, that's really a good return. We haven't seen those kind of returns in like decades, right? It's been a long time. But if Powell reduces the interest rates, you're going to see a massive set of refinancings in the mortgage-backed business. A lot of mortgages are going to get refinanced. And conversely, lowering interest rates means the opportunity cost between interest rates and equity capital asset returns is going to start favoring equity. So that means the stock market is really going to jump up. And that's great, because that means that, you know, your portfolio, my portfolio, rising tides rise with all boats. So here it is, $700,000, and of course this is all just fake stuff. And it gives you, you know, it's just got these great like visuals. And here, it just basically says by the end of 2032, I don't know, I think I put that in my, what is that, in 7 years? It's gonna, I mean, this is just all fake stuff, but regardless, it says I'm gonna have $1,060,000 based upon market returns. And then it behooves you at that point to start putting in all of your data. So all of your expense data, right? So if I went to the plan and you go to this thing called the Life Hub, this is basically telling you kind of what your profile looks like in terms of everything from assets to liabilities, and then naturally all of your recurring cash flow expenses. And it's up to you to kind of insert that information as part of, you know, what you're doing. So there's a number of different things. It categorized very simply: income, assets, expenses, insurance, savings. You know, put that information all in. It's not very hard to do. It gives you, you know, a lot of different inputs to be able to make sure that you do it correctly. And you know, it's your responsibility to make sure this data is as complete as possible. Complete meaning that you've accounted for everything that you got out there. Now, I will say this. To me, expenses is the hardest things to track. My family has one primary kind of common, you know, account. And the nice thing is it's sitting at Fidelity, and I can look at all of the various categories of expenses. In the past, I would use things like Quicken or, you know, Mint, but those are now long gone. But I do like what Fidelity does for me in that they have their own kind of retirement planning solution called Full View. But in Full View, my cash management account, it buckets everything for me. And I just found that to be extremely, extremely helpful. So think about using that. Cash management accounts are great too, because if I would use my cash management account at, say, Chase Bank for money, they pay me back the ATM fees, so it's great. And it also is fantastic overseas. So maybe another video for another time. But anyways, it's beholden upon you to enter all the data. And you know, quite frankly, let's talk a little bit about expenses. And I just talked to my financial planner the other day, and what he said to me, I said to him, you know, everybody wants to know, can you retire? I want to know the same, can I retire? And he says, well, it depends on how much you spend. And you know, I thought about that a little bit, and I said, wait a minute, how much do I spend? I was like, oh yeah, that probably makes a little bit of sense, right? I mean, you probably need to get a grip on what you're doing every day. And that's really what torpedoes a lot of households, is if you're not managing judiciously things that you don't need, then you're soon going to get bankrupt. And I have this constant discussion with my wife all the time. You know, expense management is a form of discipline. You don't always have, like, there are things that you should treat yourself with. And you know, one of the old strategies I remember back in the day was this concept of the Starbucks expense strategy, meaning that, you know, if you don't go to Starbucks and buy the latte for $6, and that's what it costs nowadays, almost $6, replace that with making coffee at home. At the end of a year, if you took that $6 and reinvested it in something, gaining some modicum of interest, you're going to come out ahead. And it's really just to demonstrate that if you don't need something, don't spend for it, because you don't, you know, things are expensive. And the same goes here. If you don't need things, you don't need to spend, then don't spend it, and try to manage your expenses. Now, there is one concept that I discovered in retirement that unless you've gone through the journey, you don't know it. But there are many people who have gone through retirement. They just don't call it this, but it's called the retirement smile. And it's essentially at the beginning of your retirement, you're going to be spending a lot of money, right? You're going to travel. Maybe you just felt like buying the Porsche, whatever. You spend more at the beginning. But as you get older, a number of things start to happen. One is your health starts to probably degrade over time. Maybe, you know, even though you're, like, I'm a very healthy person, I am feeling the effects of older age. Like, I just can't move as fast and I can't move as much. The other thing also is, at the beginning of your retirement journey, you're trying to do all the things maybe that you missed out in your younger years. So you're kind of front loading that. But after a while, you start to finish off, and that starts to taper off. My parents, for example, are retired. I remember them going on all these cruises everywhere in the world. They went on everything and everywhere. I think they went even to Antarctica on one. And they went on some boat that went out of Brooklyn, and it went around the world and ended up in Sydney, Australia. And then they took a flight into Asia and did a tour around Asia. But now, I just came back from visiting them today. They're living a sedentary life. They were just happy to have me and my son come and enjoy and we just had a wonderful lunch together, but that to them is the lifestyle that they are. In fact, so much to the point now where they are trying to give away their money. They're giving away their money. They're socking away their money as a legacy to my sister and myself, but they're also socking it away and trying to give it to my children for educational expenses. So it's an interesting dynamic, you know. I talked about die with zero. You're not going to be able to take it with you. It's nice to give a benefit to your to legacy, but at the end of the day, if you haven't depleted your income or your investments by the time of 89 or 80, you, in my opinion, have arrived. So this is something to bear in mind, that you really need to manage your expenses. And I mean, this is just basic common sense. So manage those expenses, try and get an accurate handle on it. That to me is the most important variability in the model. All right, so back to it again. Now, this is the one last feature I really just want to show you that Income Labs is kind of very cool. What I thought was a little cool, okay? And, you know, we have historical data. It's out there. It's all recorded. And if you think about the last 20 years, what are the things that happened in those 20 years? Well, we had the Great Depression, 20 years, right? We had COVID, going back. We had the credit crisis in 2008, where the entire financial markets imploded. And then we had 9/11. So those three events, in my opinion, were just seminal to many of the things that, as a retiree, you don't want to experience in those time periods. So on the Income Labs website, they have this thing called the retirement stress test. And if you look up here, they have different periods of times where, different kind of events happen. Now, I don't know, this requires a little bit of investigation, and I didn't do it, but I don't know if this is normalized at all, because remember, money back then was a little different. It didn't flow as fast. And also, I don't think that, there was as much money as what we have today. What I do think is kind of cool, there are some more modern events that happened, and you can toggle on these things up here, and it basically tells you what your guardrail scenario could be based upon the balance you gave it, right? And it's saying that, here's what it is. You can spend anywhere between, the bottom one are the guardrails and the balances within that performance band. But the top one at that time period is essentially what you could have spent based upon the inputs you gave. And that to me is the best form of backtesting. You have previous events that happened and you're just measuring yourself against it. Monte Carlo would do the same, but it's just not driven by an event, like a historical event. Okay, so that's it for now. I just wanted to give you a flavor of how Income Labs works, because I do find it to be a really robust solution and one worth potentially looking at in terms of your retirement strategy. I think it's also worth having multiple of these kinds of solutions and start refining them and curating them for the data that's important to you. But the key thing is make sure all of that data is in there, because if it's not, you're going to get really wildly bad results. And in closing, that's the thing that I found kind of complicated with some of these things. There's another solution. There's a bunch of guys out there. I think the company's called Root Financial that makes the software. But when they show, these two gentlemen, when they show their analysis, they have a different instance than the one I was given, but also the tuning of the data becomes really hard to understand. So just be cognizant of that. Try and get help. There's a lot of resources online and communities that you can use. But that's it for now. We'll do another subsequent video, get a little deeper in the Income Labs. And then, you know what, I'm going to do a Bolden one for you too, because that's, to me, the granddaddy of them all. That's the one I trust and rely upon. And I'm using that day in, day out, just like my checkbook. I'm looking at that all the time, refining those inputs. And one of the things that I want to do is I'm going to take a snapshot of what Bolden did at, when I entered the data. I think I have that snapshot today. And then I want to look at it at the end of the year and see how it measures up. Great. Well, thank you for watching, and we'll see you in the next one.